when it comes to fundamentals, is the market maybe, as our last guest suggested, Steve Englander, over-egging it relative to the fundamentals?
It needed to correct. I think we're now back on the S&P 500 to 15, maybe slightly higher forward PE. That feels a lot more comfortable than where we were, and a lot more comfortable than the historic-looking PE. So, you know, a correction is a good thing when you're overvalued, and the US market was overvalued. Europe, I've been a little bit more surprised about. I think there was value in Europe before this correction, and there's more value now. And I think that might be an interesting market if anybody wants to bottom dip or bottom feed.
And that's what you're suggesting today?
If I was an equity fund manager,
which you're not.
Which I'm not.
But as a bond fund manager, what are your thoughts?
So I think we've still in fair value at best territory. Credit's been really stable, and in many ways that's going to give a lot of equity investors a good deal of comfort.
Does that remain the case? And what are the signs it might not remain the case?
So if inflation really picks up, if capex really picks up, if we get a Fed who get aggressive with their hiking and the ECB stop in September, full stop, rather than taper, maybe those are the things that threaten credit to some degree. But right at the moment, fundamentals are great. Growth is good, balance sheets are fine, leverage may be up a little bit, but it's nothing too dramatic.
So everything's still a bit Goldilocks?
Afraid so, yeah.
Really?
Yeah. In credit.
In credit?
Yeah.
Yeah, and so as long as the Fed keeps gradual, as long as inflation doesn't get out of control, are there any signs from the metrics you're looking at that inflation is maybe picking up more than the markets anticipate?
Well, I've been looking for higher inflation for a while, and Friday was a bit of a...
with the wages?
Yeah, with the wages was a little bit of a sign that that's the direction we're going. And I think you've seen some signs that the big cities in the US have been getting wage inflation coming through, and this was the first sign it's spreading out. We've got German negotiations from the unions going through right now, so over the next few weeks, maybe a month, we're going to get results in Germany as well, which could be a little higher.
Yeah, and the IG result was roughly, if you iron it out over a couple of years, around 3%.
Yeah.
Is that, going back to the not too hot, not too cold scenario,
now,
is it okay for now for the ECB?
Yeah.
I mean, it suggests there's some evidence of the ability to wage bargain, but that's Germany. That's with the lowest unemployment rate on record. What about Spain? What about Italy? What about some of these other countries? Is there an ability to engender some wage inflation?
It's getting there. You're starting to see capacity taken out across Spain and Italy and back to not quite full capacity yet. There's still spare in Spain and Italy, we think, but only months away, maybe 6 to 8 to 12 months away before that capacity goes again. And Germany has got through its spare capacity 2 years ago. So, you know, the whole of Europe's being lifted. I think that is where inflation could surprise, and that's where I'd like to see yields higher rather than actually over in the US.